In the news, commercial lending's collapsing. The latest data from Goldman Sachs is showing about CMBS issues for the first quarter, lowest level since 2010. Banks reducing the amount of leverage, LTV ratios. And then we've seen an increasing share of banks reporting tighter lending conditions during the last 2 weeks of March with their Federal Reserve filings. So that's the news. What are we thinking, and what are we actually seeing in the market as we're talking to banks and whatnot?
You're raising your hand. You're it.
I
Yeah,
am.
you're tagged.
Well, I was a lender for a Wall Street firm during the 08-09 collapse. It was a Wall Street firm. It was GMAC Commercial Mortgage. It's not one of the big five that you've heard of that's like the most famous one, but I mean they were off Wall Street. This is eerily similar to what we saw at that time. So when I was a lender, I got a call one day in like March or April of 2008 and was told, no more loans. I go, what do you mean, no more loans? That's what our business is. What are we going to do? Sit around and, watch TV all day? And I probably didn't say TV, but the point was, I said, look, unless it's a relationship that has 5 or 10 loans that we've done and that you know personally very well and is a big shot, we're closed for business. And at that point, we had seen tightening the same way that we're seeing it now, is almost 500 basis points in the same amount of time, and we closed the market. That's what we're seeing. Jeff and I.
That's actually what we were just told.
Yep.
We got in just before from one of our lenders before they closed down and said, no, we're going to move your we like you. We're going to move your application forward. But if you guys change the structure or if you do anything else, you're out. We're only lending to our known entities, people we want to deal with.
Yeah, it really does seem. It seems like.
Go ahead. I'm sorry. I apologize.
I'm gonna have another sip. Go ahead, Zach.
Well, this is what happens when we get together. What we're seeing is the yield constant that we have to underwrite in a deal is crushing prices. And so closing for business is basically stagnating real estate to the point where you're not going to see any transaction.
Yeah, what I was going to say is it really seems that things were tight a few weeks ago, but it seems like there's been a noticeable thing, things even tightening more. Like you were saying, even almost seeming like they're going to a point where you just can't get the loans at this point.
Well, I mean, I think if you add the constant that we're aware of, which is potential bank failure, run on deposits, you have banks that are scared of that. You have banks that are scared that their portfolio that they've lent on could be potentially underwater. If you remember, there was 3 years ago, 5 years ago, 7 years ago, you were looking at loans that had just been outstanding that are now coming due, that were priced wildly under what they could be right now. So if I'm a bank, I could appreciate the side if I'm having to deal with tier 1 liquidity and how I'm going to lend or how I'm going to keep my bank afloat. I'm scared to lend.
Raise my hand again.
There.
I've got a lot to say about this because there was an article that came out this morning, unrelated to what you just said, but completely related. And Jeff hit the nail on the head: liquidity.
Yep.
So the Fed's liquidity with this debt ceiling crisis is exacerbating the situation. Their liquidity is down to less than 50 billion, right? And it normally is around 500 billion. If the debt ceiling is raised, which we all want it to be, so there's not a greater catastrophe, they're going to suck so much liquidity out of this market overnight that any lender that's still in this market is going to be out of this market instantly.
Yeah. Well, I think also you got kind of what Jeff was also alluding to is you got two other issues going on here too. Of one, you got a lot of banks that are worried about a run, worried about depositors going. I mean, and there's a couple different things driving that. One is the too big to fail. I mean, if you're at a mega bank, you don't really have to worry about Chase going out of business because the government will do whatever they can. But if you're a small or regional bank, they got to worry about those depositors going to a too big to fail bank. then you've also got the fact that some of them didn't manage their duration risk well, so they really can't offer the same interest rates you could get with T-bills, or maybe you move money to a brokerage and you get it short-term money funds or whatever. But you got that risk of people, going for yield, but by leaving them.
Sorry,
Right.
What are you laughing
I'm
at, Jeff?
Yeah.
I'm laughing because I mean this of no disrespect. You're saying things that even I understand what they mean. But I think in layman's terms, what you mean, you people who didn't actually, people who were investing that weren't weighing the risk, not even considering the fact that while we're going through a potential downturn, I was fortunate enough in my banking career to not just create a stress test policy, but design the template that it did it. And when you actually look at it, I scheduled and I created that template based off of if 5%, if you had loan loss of 5%, 10%, 20%, 30%, at what point are you no longer able to be even a bank? When you add the fear of, did I invest my money right, compounded with the fear of, oh my God, if all these loans fail, or they've got to be short sold, or what are we going to do? How are we going to do it? How do we survive?
Yeah, and I think that the other thing I was going to get to is that loan
Wait, you were
issue
a
of.
banker?
No, no.
But yeah, what I was going to say is to the loan issue, you don't need the entire commercial real estate market to have problems. It is just enough that some downtown office markets are having problems. That's enough to put some of these loan portfolios at enough risk, especially when you compound it with the risk of a run on your depositors, to get a lot of these banks to just basically say we're closing shop. We don't want to issue more loans, and I think we're kind of worried that that's what we're seeing right now.
Well, I think it's even one step further, not to get really too deep into the weeds, is, banks have outside auditors, they've got, regulators, I mean, that are trying to watch and tell them everything that they should and shouldn't be doing. And the irony of it is, and of no offense to the FDIC or any of the rest of them, coming and telling people how to lend on products that they should be lending on, when in reality, the FDIC comes and says, well, holy crap, we had a pandemic. Why are you lending on office? Well, depends upon, like, to your point, what market are we in? Where's the property? What type of office property? It gets drilled down so far that, at some point banks are just inundated by crap that they just can't overcome. And
That's
that fear alone is crazy.
that's an important point. Adding to this segment, because I know we're gonna talk about a few others. So what do you do?
Yeah.
Right? Because at this point, office lending, we can tell you, is dead. There's not an office loan to be found. If you're going to find one, it's going to be some 15 or 20% interest rate, hard money loan that you're never going to survive. Multifamily is struggling. Industrial is struggling. So what do you do? What we have found at this point is you have to find and uncover these overlooked markets with strong trending demographics, i.e., massive migration and development dollars pouring in. For example, our Savannah property is right down the road from the Gold Star development deal that was highlighted in every major publication this week, right near the Hyundai development battery plant that they're building to supply the entire United States. And that market is booming. And we actually have Hyundai,
headquarters.
and we have Hyundai as a tenant. So,
Yeah.
we went out and we locked down our office property to ride out the next 2 years, being in the market that we were in and targeting the tenant that we had to target. Because outside of that, you're
And we're
kind of
still
dead in the
finding,
water.
and the irony is we're still finding that, we're getting increased activity because of people that are trying to be, third-party affiliate distributors, or, et cetera, for Hyundai. So yeah, I mean, I agree with that sentiment as well. You're not trying to find the diamond in the rough. You're just trying to find the right demographics of where people are moving, what people are doing.
Yeah.
We've had a lot of success with that.
Yeah, I think, and we'll move on here pretty soon, but I think the big challenge we're seeing is it's always challenging to find good properties. But we're finding those. It's becoming an increasing challenge to get the financing for them as we speak today.
Well, I think it's increasingly difficult to not just find good properties, but find people that aren't willing to sell you a pipe dream. We're looking at stuff, very conservatively and underwriting it very conservatively because we don't want to just survive a downturn. We want to excel through it and do it based off real metrics, not a target IRR or target ROI that's 10 basis points apart, a
Well,
10
guys,
to a 20. How does that make
we're
sense?
we're not selling anything here.
No,
Obviously we're
I'm
selling.
not even
Look, I
trying
mean,
to.
we look great, so don't worry about it. But we sell ourselves. Um, in terms of the lending, and that's kind of where it all ties in, is finding these markets and these properties where you actually have a fundamental basis to buy a deal.
Sure.
There is still a lender out there for that. The terms aren't great, but that does still exist. It's just finding a needle in a needle stack at this point.